Hi there, and thanks for joining us here at PhillipCapital Market Watch. I'm Rong, research analyst from Phillip Securities Research. Nearly 3 weeks after Election Day, President Trump has not conceded the presidential race and is still trying to overturn the election results. He may be running out of time as electoral disputes have to be resolved by the safe harbor deadline of 8 December. Considering that he has to overturn the results of at least 3 states in order to exceed the 270 electoral votes needed to secure the presidency seat, his chance of success remains slim. With markets largely pricing in a Biden win, key focus will be the runoff elections on 5th January 2021, which will determine the control of the Senate. The only way for Democrats to win the Senate is to clinch the 2 Senate seats in Georgia to secure a 50-50 tie, and for Vice President Kamala Harris to give a majority to her party. This is highly unlikely, but possible. A more likely scenario is for the Democrats to win 1 seat in Georgia, with the Republicans retaining control of the Senate on a 51-49 lead. In a divided presidency, Biden's economic and fiscal plans may face opposition from the Senate. The fiscal stimulus relief gap between Democrats and Republicans is currently large, at US $2.2 trillion versus US $500 billion. A compromise remains challenging. The previous bill to fund the government will expire on 11 December. If some form of relief stimulus is passed alongside a new bill before 11 December, markets will be chirped. However, it remains questionable if Trump would sign the bill into law at the moment. A more likely timeline we think is February 2021 after the inauguration. We favor the clean energy space with a Biden win. Although a split Congress may imply reduced green-focused stimulus, we believe the circular shift towards clean energy will accelerate during his term, as companies align themselves with the government's green direction. We also favor the healthcare sector, particularly pharmaceutical, biotechnology, and healthcare service providers. A divided Congress could mean resistance to big legislation, and we may end up with little or no structural change. This will remove uncertainties for the sector and is largely seen as positive. Limited or no tax hike should favor financials, particularly the larger banks whose profits broke new records in 2018 after Trump's 2017 tax cut. A split Congress may produce resistance to the reinstatement of financial regulations rolled back by Trump. Big tech may also gain from continued tax savings and gridlock in the implementation of regulation. Another key focus will be the COVID-19 situation in US. Hospitalization and ICU patients have trended up with the third wave and have exceeded the severity of the first 2 waves. Coming winter season could provide an environment for increased contagion as people are confined indoors by the colder weather and shorter daylight. There are reasons for optimism with Pfizer's BioNTech and Moderna's vaccine. An efficacy above 90% towers above the 40 to 60% for normal flu vaccines and the FDA's approval criterion of 50%. It could also accelerate the race to find the next winner. Other vaccines companies will be under pressure to deliver so as not to lose out and lose revenue opportunities. This may hasten the pace of vaccine development, and any positive news flow may drive rotation into value stocks. However, investors have to dig in for longer term. We believe that the positive impact from vaccines may not materialize until around end Q1 or early Q2 next year. Our rationale is that manufacturing and distribution will take time. Herd immunity requires 70% of the population to be immunized. With limited manufacturing capacity, we may not get there until mid-2021. Furthermore, the timeline needed to gain protection after vaccination is around 28 days. The incubation period for COVID-19 is 5 to 6 days on average. If no proper control measures are in place, the virus will still spread faster than the rate of vaccination in the near term. Investors would do well to adopt a balanced investment strategy in my view. They may diversify some capital to value stocks while maintaining exposure to growth stocks such as technology. Value and growth stocks have made an uneven recovery from COVID-19 since end March. Their huge divergence may allow value stocks to catch up in price performance when things normalize. That said, investors have to be in for the longer term. The mass distribution of vaccine will take time, and their positive impact may not be felt until around end Q1 or early Q2. Until then, virus resurgence and tech stock resilience during this pandemic can continue to gain traction. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Also, tell us what you think. What other post-election focus do you foresee? Leave your comments. Thanks for joining us and see you soon.